listen to me very carefully, because what just happened at the Federal Reserve Bank is not just another news cycle story for you to scroll past on your phone while you're sitting on your couch wondering why your savings account feels like it's bleeding out. The Federal Reserve just made 3 announcements, 3, and every single one of them has a direct, mathematical, unavoidable impact on your paycheck, your mortgage, your savings, and your ability to build any kind of real wealth in this country. Most people are going to hear about this, nod their heads, and do absolutely nothing. And those are the same people who will be complaining 5 years from now about why they can't afford a house, why their grocery bill keeps climbing, and why their 401k isn't going anywhere. I am not here to be kind to you. I am here to tell you the truth. And the truth is that if you don't understand what the Federal Reserve just did and what it means for your money, you are going to get eaten alive by this economy. Before I go any further, I need you to do one thing right now. Hit that subscribe button. I know you've heard that before, but let me be extremely clear with you about something. The kind of financial intelligence I'm about to give you in this video is the same analysis that people in boardrooms and hedge funds pay thousands of dollars per hour to receive. You are getting it for free right now because you happen to find this channel. So if you are serious about your financial future, you subscribe, you turn on the notifications, and you do not miss a single video. That is the deal. Now, let's get to work. The Federal Reserve just made 3 major announcements, and I want you to treat each one of these like a punch, landing directly on your financial face, because that is exactly what they are. If you are not prepared, the first announcement is that the Federal Reserve is not cutting interest rates. President Trump has been demanding lower interest rates loudly, publicly, and repeatedly, and the Federal Reserve looked him dead in the eye and said no, but here's the part that most people are glossing over. They also did not raise interest rates. They held, they froze, they sat on their hands. And the reason they did that is not confidence, it is confusion. The Federal Reserve Bank, the most powerful financial institution on the planet, with access to more economic data than any organization in human history, looked at this economy and said that they genuinely do not know which direction it is heading. Think about what that means. They do not know. And if they do not know, you can be certain that your financial advisor does not know. Your brother-in-law who watches business news does not know. And the guy on social media selling you a course about passive income absolutely does not know. The second announcement is more alarming than the first, and I mean that in a very specific, data-driven way. The vote that produced this decision to hold interest rates was the most divisive vote inside the Federal Reserve Bank that we have seen in decades. This is not a minor internal disagreement. This is a full-scale ideological war happening inside the institution that controls the price of every dollar you earn, spend, borrow, or save. You have one faction inside the Fed saying that we must raise interest rates immediately to save the dollar. You have another faction saying that we must cut interest rates immediately to save the economy. These two positions are not close to each other. They are not two slightly different shades of the same color. They are diametrically opposed policy prescriptions. And the people making these arguments are not amateurs. They are economists with decades of experience and access to the same data. The fact that they cannot agree is not a bureaucratic footnote. It is a 5-alarm warning that the economic situation in this country is far more precarious than the headlines are telling you. The third announcement is the one that nobody fully saw coming, and it has long-term structural consequences that will outlast this news cycle by years. Jerome Powell, the chairman of the Federal Reserve, announced that he is stepping down as chairman. His term expires May 15th, and that part we already knew. But he made a statement that changes the power dynamics inside that institution in a very significant way, Powell said, and I'm going to be precise here because the exact language matters. He is not leaving the Federal Reserve Board. He is stepping down from the chairmanship. But he is staying on as a board member until the Department of Justice investigation into the Fed is fully resolved with, in his words, transparency and finality. Now, why does that matter to your wallet? Because the Federal Reserve makes its interest rate decisions by majority vote, and there are 12 voting members on that board. Kevin Warsh, who President Trump has nominated to replace Powell as chairman, now has to walk into that institution knowing that his predecessor, a man who publicly disagreed with Trump's demands for rate cuts, is sitting at the same table, still casting votes, still wielding influence, If you thought that Trump appointing Warsh meant a clean, guaranteed pivot to lower rates, you need to think again, because the math inside that boardroom just got a lot more complicated. Now I want to talk to you about something called the net interest trigger, because this is the financial landmine that is sitting underneath everything else we are discussing. And most people do not even know it exists. The United States government currently carries more than $39 trillion in national debt. I want you to sit with that number for a moment, because it is almost too large for the human brain to process. $39 trillion. That is money the government has spent that it did not generate through taxes or any other legitimate revenue source. It borrowed that money from American citizens through treasury bonds, from foreign nations like Japan, China, and the United Kingdom, and from the Federal Reserve itself. And now, the cost of servicing that debt, meaning simply paying the interest on what is already owed, not paying down a single dollar of the principal, has crossed $1 trillion per year. $1 trillion every year just in interest payments. The United States government has exactly one primary source of revenue, and that is your tax dollars. That means that roughly 20 cents out of every single dollar you pay in federal taxes is going directly to interest. Payments on debt, not to roads, not to defense, not to Social Security, not to any program or service you could point to and say, that is where my money went. 20% of your federal tax bill is going to service the interest on debt that was accumulated by decades of government spending beyond its means. And now the Federal Reserve is being forced to confront a question that it has never had to answer quite this directly. Is its primary job to manage inflation and stimulate employment, which has been its traditional dual mandate, or has that job fundamentally changed into something else entirely, namely trying to stabilize the United States dollar and prevent the interest costs on the national debt from spiraling so far out of control that it destabilizes the entire financial system? This is not a theoretical debate happening in academic journals. This is a live, urgent question that is being asked inside the Federal Reserve right now. And the answer they arrive at will determine the direction of interest rates, the value of your savings, and the cost of every loan you carry or plan to take out. Let me tell you about Kevin Warsh and the gamble he is proposing, because this is where things get very interesting and very dangerous simultaneously. Warsh has articulated a two-part strategy that sounds elegant in theory but carries execution risks that could shake the entire financial system if it does not work the way he believes it will. Part one of his plan is to cut interest rates. The logic is straightforward. Lower interest rates make it cheaper to borrow money, which means mortgages become more accessible, business loans become cheaper, consumer spending increases, and money flows more freely through the economy. That is the stimulative effect, and in a slowing economy, that is exactly what you ought to see happen. But here is the problem that anyone who has paid attention to the last 5 years should immediately recognize. Cutting interest rates in an inflationary environment is like trying to put out a fire with gasoline. If mortgage rates dropped to 4% tomorrow, the housing market would be overwhelmed with buyers overnight. Every person who has been sitting on the sidelines waiting for rates to come down would rush into the market simultaneously, driving up demand, driving up prices, and fueling the exact inflationary pressure that the Fed is already struggling to contain. This is not speculation. This is basic supply and demand economics. And it is the reason why the Federal Reserve has been so reluctant to cut rates despite enormous political pressure to do so. So Warsh's answer to this problem is part two of his strategy: shrink the balance sheet. The Federal Reserve's balance sheet is essentially a record of all the money that the Fed has printed and lent to the United States government over the years. When the government needed to borrow money that didn't exist, the Fed created it digitally, effectively out of nothing. And that newly created money inflated the money supply, which contributed to the inflation problem we are living with today. Warsh's theory is that if the Fed sells off these treasury holdings, meaning it offloads the loans it made to the government onto private buyers, it effectively removes that money from circulation, which counteracts the inflationary pressure caused by cutting rates. Cut rates to stimulate the economy, shrink the balance sheet to keep inflation from exploding. That is the thesis. It is intellectually coherent. But here's the risk that Warsh himself has acknowledged. If the Fed stops buying treasuries and starts selling them, that means the United States government suddenly has fewer buyers for its debt. And when there are fewer buyers competing to lend money to the government has to make its debt more attractive by offering higher interest rates. Higher treasury rates mean higher mortgage rates, higher car loan rates, higher credit card rates, because every interest rate in the financial system is priced relative to the treasury rate. Warsh believes that private demand will fill the gap. He believes that other buyers, individuals, institutions, foreign governments will step in and absorb those treasuries without requiring significantly higher rates. That may happen, but if it doesn't, you are looking at a scenario where the Fed is simultaneously cutting rates at the short end and watching rates rise at the long end, which would be a financial paradox of historic proportions. I want to make absolutely sure you understand the inflation trap the Federal Reserve is caught in right now, because this trap directly explains why your cost of living keeps going up even when the headlines tell you inflation is under control. Right now, inflation is already running above the Federal Reserve's 2% target. That means prices are already rising faster than the Fed wants. And on top of the existing inflation problem, you have rising oil prices, driven by ongoing conflict in the Middle East. And higher oil prices are not just about what you pay at the gas pump. Higher oil prices make diesel more expensive, which means every truck that moves freight across this country is running on more expensive fuel, which means the cost of shipping everything, groceries, appliances, building materials, medical supplies goes up. Higher oil prices also make fertilizer more expensive, which means the food being grown in American fields costs more to produce before it ever reaches a store shelf. Higher oil prices are an inflationary force that cuts across virtually every sector of the economy. And nobody can tell you with certainty how long the Middle East conflict will last or when oil prices will stabilize. So the Federal Reserve is staring at an inflation problem that is being amplified by external forces they cannot control at the exact same moment that there is growing economic pain that is pressuring them to cut rates and stimulate growth. Part of this economic weakness is structural. Artificial intelligence is automating portions of jobs across multiple industries, which is reducing labor demand and creating uncertainty in the employment market. Part of it is psychological. Businesses are so uncertain about the economic outlook that they are choosing to pause hiring rather than expand, which creates a feedback loop of economic slowdown. Cut rates, you risk an inflation explosion. Raise rates, you risk crushing an already weakening economy. Hold rates, you solve nothing and lose credibility by the day. This is not a comfortable position to be in. This is a genuine economic dilemma without a clean solution. And the people sitting in that room at the Federal Reserve are not idiots. They are facing a problem for which the traditional playbook does not have a clear answer. Now, let me tell you what all of this means for your money specifically, because this is where I need you to stop thinking abstractly and start thinking about the dollars that are in your bank account right now. The average working person in this country is poorer today in real terms than they were before the pandemic. And that is not a political opinion. It is a mathematical reality. From 2020 to today, the United States has experienced a cumulative inflation rate that has fundamentally eroded the purchasing power of every dollar you earn and save. The reported number says approximately 22% cumulative inflation over roughly 6 years. But here's what that number does not capture. It does not capture the way housing inflation is currently measured, which systematically understates the real cost of putting a roof over your head, whether you rent or own. It does not fully capture the spike in home insurance premiums, property taxes, grocery prices, vehicle costs, or the various service costs that have all risen faster than the headline number suggests. What most Americans feel in their daily lives is an inflation rate significantly higher than what is officially reported. And the reason for that gap is that the definition of inflation itself has been revised multiple times over the past 40 to 50 years, always in ways that tend to produce a lower headline number. Your paycheck, for most working people, has not grown fast enough to keep pace with this real inflation, which means an actual purchasing power in how much food, housing, transportation, and goods and services your paycheck can actually buy. You are behind. You are losing ground. And here's the brutal part. The very mechanisms we have been discussing, money printing, debt accumulation, balance sheet expansion, are the forces that cause this purchasing power erosion in the first place. Every time the Federal Reserve prints money to fund government spending, every dollar already in circulation becomes worth fractionally less. Your savings account balance might say the same number said 3 years ago, but that number buys less. Your salary might have gone up by 3%, But if real inflation ran at 6 or 7%, you took a 3 or 4% pay cut in real terms, and nobody told you. This is not accidental. This is the predictable, mathematical consequence of monetary policy decisions that have been made over decades. And if you do not understand how this system works, you will continue to be on the losing end of it, while the people who do understand it position themselves accordingly. Kevin Warsh taking the chairmanship on May 15th, with Jerome Powell still sitting on the board, with a divided voting bloc, with a $39 trillion debt overhang, with oil-driven inflation pressure, and with an economy that is showing real signs of slowing. This is the environment your money is going to live in for the foreseeable future. The question is what you are going to do about it. I am going to lead you with this, and I want you to hear every word. You have two choices right now. You can close this video, go back to whatever you were doing, and trust that somehow, some way, the government and the Federal Reserve are going to figure this out, and your financial situation is going to improve on its own. That is a choice. Millions of people will make it, and 5 years from now, those same people will be angrier, more financially stressed, and more confused about why everything keeps getting harder, despite the fact that they work just as hard as they always have. Or you can choose to be the person who actually understands the system, who understands that inflation is a tax you pay whether you vote for it or not, who understands that the Federal Reserve's decisions determine the real value of every dollar you earn, who understands that the time to prepare for economic turbulence is before it arrives, not after. The changes coming on May 15th, the decisions Kevin Warsh is going to make. The inflation dynamics are already in motion. None of this is going to wait for you to get ready. The market does not care about your feelings or your timeline. So you need to get educated, you need to get positioned, and you need to start making decisions based on reality, not on wishful thinking. Subscribe to this channel. Share this video with someone you care about who needs to hear it, and start taking your financial future as seriously as the people running these institutions take theirs, because they are absolutely taking it seriously. The only question is whether you are going to do the same.